Let's now start off with an introduction to closed corporations. Now, just a bit of theory, right? A closed corporation, you'll see I often refer to this as a CC, is a form of business that is registered and operated under its own act, the Closed Corporations Act. Now, there's been some amendments, and basically it falls under the New Companies Act, but just for now, understand that there is an act. It creates, this act, this legal legislation, creates a separate legal person. Often I will call this a juristic person. So it's very different to like a partnership, for instance, where the partners were the business. Here, the closed corporation is separate from the owners. Okay, owners can come and go, but the closed corporation as a business will continue without any changes. Here, we don't call the owners partners or shareholders. We call them members, and they don't have shares like in companies, but they have a member's interest. And this is described as a percentage. So you may be a 20% owner or member in a CC. Okay. From 1st of May, there are no new CCs that may be registered, no more closed corporations. Okay. And you can continue with your CC, or you can convert it to a private company. And this is all in terms of the New Companies Act 71 of 2008. Now just some attributes. Let's go through these one by one. Spend a few minutes. It gives you a feel for what a CC is. What I've done is I'm going to list a whole bunch of attributes of businesses and compare it to a sole prop, a partnership, and a CC. So first of all, is it a legal person separate from the owners? Well, we know for a sole prop and a partnership, the answer is no. There, the business owners are the business. With a closed corporation, however, the answer is yes. It's a separate person, not a natural person. It's a legal juristic person, right? Number of owners. This indicates the access to capital, right? So a sole prop, obviously there's only one owner. Partners could be 2 to 20 partners. Closed corporation is actually less than a partnership. It's 1 to 10. And what do we call these owners? They are referred to, well, a sole prop is a sole proprietor. Partnerships, you have a partner, and we work a lot with the profit sharing ratio to dictate how much of the profits the different partners get. With a CC, we call the owners members, and we work with a member's interest percentage. Okay. Unlimited existence, i.e. if a partner or one of the business owners retires or dies, will the business continue without them? Okay. So we call that unlimited existence. The sole prop, definitely not, right? If the one owner dies or stops working, the business stops. With partners, well, remember we dealt with in study units 2 to 4, if one of the partners leaves or a new partner is admitted, the whole old partnership is dissolved because it was just an agreement between those specific partners. If we have one partner leave, we need a whole new partnership agreement. So there is not unlimited existence. With CCs, however, if one member retires, sells his shares, or dies, the CC continues going without being, well, uninterrupted, right? Then, are the business owners protected with limited liability? I.e., is their liability limited? So, for a sole prop, if that business incurs debt, okay, the business owner incurs the exact same debt because they're one and the same. Same with partners. And with partners, it goes one step further, is there's joint and several liability. So if one partner runs up the debt for the business, all the other partners are bound by it. Okay. With a CC, we do have limited liability. That falls away if we contravene any part of the legislation applicable to CCs. Okay. But if we're in terms of the law, we're operating well, we have limited liability. Okay. Is the business taxed separately from the owners? Well, with sole props and partnerships, we know the answer was no. The partners and the sole proprietor pay tax in their own capacity. A CC, however, pays tax as a CC. Then there's distributions of profits to the members, and those are tax exempt for the members. Can the business acquire rights to assets in its own name? Well, for a sole prop and a partnership, the answer is no. Okay? Because the business and the owners are the same. Whereas with a CC, we can actually purchase a vehicle in the name of the CC. If it's a bucky, we could claim the VAT in the name of the CC. Okay? The individual owners do not have a right to that. They have the right to the member's interest in the CC that owns the vehicle. Same thought process. Can the business incur obligations or liabilities in its own name? Obviously for sole props and partners, no. But it's very common for CCs as a separate juristic person to go and borrow money or incur a bank overdraft in its own name. Then, before distribution of profits can occur, do we have any legal requirements? Well, for a sole prop and a partnership, no, not at all, because the profits already belong to the business owners. But for a CC, there must be compliance with the Closed Corporations Act. And that means before there can be any distributions of profits to members, the CC must be solvent, i.e. the assets fairly valued exceed the liabilities fairly valued. And it must be liquid, which means it's able to pay its debts as they become due in the ordinary course of business. So we're dealing with CC, closed corporations, are just compared to the two business forms you know well already, the sole prop and the partnership. Now this is very important. Here, this gets a big NB. This will form part of exams, right? How does equity get represented in the statement of financial position? For a sole prop, well, it was quite easy. All you had was the capital account and reserves. Partnerships, well, you had the capital accounts. That was the original capital contribution. And then the current accounts, where we had all the yearly profits that were left. And some of those profits were also put aside in reserves. And the most common two were the asset replacement reserve and the revaluation reserve. Now, nothing to really worry about here. We're just going to call things a different name. First of all, in the CC, we don't have capital accounts. We have members' contribution. Okay? In companies, we'll deal with share capital. But in the CC, we have members' contribution. Then we have retained income. And then we can still have all the other reserves that we normally have, right? Okay, so just also remember that there's one other little thing. In the sole prop and the partnership, when partners or business owners took money out of the business, we called it drawings. For a CC, we call it, there's no dividends, it's called distributions in a CC. Okay, so this is very important, guys. You must know the different types of names of equity, and that's the big difference. So for the rest of this study unit, I'm going to cover some basic theory, guys. I'm going to ask you to do some reading. Okay. Then after that, we're going to come spend some time on the financial statements and a lot more time on the notes to the financial statements with the CC. Very specifically, we're going to do the members' loans. We're going to do transactions with members. We'll do the PPE note and financial assets and liabilities. Those videos are vital. The reading through the theory, guys, take an evening, read through the theory. That's all online and in your slides. But it's all going to come back. The difficult stuff's going to come back to the different ways we deal with equity. Okay. Not difficult, just different. Okay. So let's get it cracking. Guys, finish up this chapter as quickly as possible. We've still got a long way to go in the study unit. Cheers.